Okay, folks, how's everybody doing? This is Mike Pawnee here, Savvy Investor. Hope you guys are all doing well. We are just going to give everybody about 20 seconds as they log in. So as you guys are logging in, please, as I always like, just make sure you say hello. Let us know where you guys are dialing from and joining us from, because we always want to make sure that we say hello, get a chance to know each other, connect. It's all about networking as well. So it's really, really important that we have that open dialogue with everybody. So again, for those of you that are relatively new to Savvy Investor, I first want to say welcome. This is maybe your very first live session with Savvy Investor. I highly encourage a lot of these individuals that are just relatively new to Savvy, make sure you check out a lot of the video links that are on the media side of the Facebook page. And secondly, if you go to units, there's some fantastic training that's also there as well. Okay, so for a lot of people, this is a hot topic. I'm quite excited to have Cherry Chan here. So because it is a very good and important presentation, because I think for a lot of people are liking to keep their money in their pockets, Cherry, and not necessarily giving it to the government. And so we're all looking forward to this advice and this information that you're going to provide us. So we are looking forward to this. So with that being said, again, for you guys that are relatively new to Savvy Investor, and this is your first Facebook Live with us, again, make sure you say hello. It's great to see you, Garrett. Great to see you, Nick, Sherry Harbor. How are you doing? So as you guys are joining us with the group, make sure it's interactive and ask a lot of questions. I go, this is really designed for all of you. And so here's an opportunity where we can speak to a sophisticated real estate investor and accountant and are experts within their field to ask the questions that you may be nervous to ask. Because I would imagine that for that one person that has that really, really important question, others will have that same question as well. So as you post, just share it in the comments, your questions, and I'll make sure that I respond and share that with Sherry shortly. So without further ado, I'm going to introduce Sherry, and I actually don't know Sherry too well, because actually we met just a few weeks ago, but I've actually known her husband, with many of you may already know as Erwin Cezetto. And Erwin and I go back a long ways based on our real estate inner circle there. And so, you know, Cherry's from Ontario. And so I was able to connect with her, but the one thing I've been watching is Cherry and Erwin really just being very, very visible out in the marketplace, and many cool different things that I'll ask some questions about as well. But they've done some really, really incredible stuff and really have given back as well to charities as well. And they've done some absolutely amazing things. So when I thought about having an accountant join us for the Savvy Investor page, the first name that came to my mind was Cherry. And I know just based on her experience and knowledge. So without further ado, Cherry Chan, welcome and thank you for joining us. I really, really appreciate that.
Oh, thank you so much for introducing me as Mrs. Cito. Typically, it's the other way around. People would call him Mr. Cherry Chan. That's how he nicknamed himself.
Yeah. I think it's right. That's the right way to do that, to be honest with you.
Yeah, that is a joke. Yeah. So I appreciate your introduction. We do a little bit of charity work. I think the goal is to give back as much as possible.
Yeah, well, especially during this time, and that's the one piece that we all got to remember is, you know, the pandemic's hit a lot of people, and maybe some people not to the same level. And any small little thing that we can do to help support our community, the better, absolutely, especially during these challenging times. So, so Cherry, you know, obviously this, for a lot of people have never heard of you, don't know anything about you. So maybe instead of me tooting your own horn, maybe you can toot yours a little bit on your own and just share a little bit about, you know, who you are, what you do, how'd you get started in real estate investing? Because I think for a lot of people, there's a lot of experience that is here and lots of great lessons as well. But, you know, obviously, if you won't mind sharing a little bit about yourself and maybe about a little bit of your real estate journey as well.
Okay, great, because then we will be here for the entire night.
Well, make it small.
So I'm a chartered accountant. I have my own accounting firm. At the beginning, when I first met Erwin, actually it was when I first met Erwin, I already got my first home. And it was a townhouse in Toronto. And at that time I was single, I was by myself, and my paycheck, it was just enough to cover the mortgage and also my nice fancy car. I was your typical rich dad, poor dad, middle class, spent everything. And then I met Erwin, and through that network, it was the first time that I recognized, hey, I could actually afford to buy an investment property. It does not have to be in Toronto. I could buy it outside of Toronto in a nice area in a like at the time we chose to go to St. Catharines and buy it in near Broad University. And so we started the journey by refinancing my townhouse that I purchased earlier during the year. And I was able to pull out $40,000. And that's how I started my investment journey, buying my very first student rental. And supposedly I'm the money partner. I was the money partner. I didn't understand that joint venture terminology. I don't understand why I had to give him the 50%. Right. We were just dating at the beginning. I was thinking, even if our relationship doesn't work out, he has no title and we never signed anything. So I guess he's just going to be giving up his 50%. Fortunately, things work out. He was always asking me, why are we not opening a bank account together? I'm like, why do you want to open a bank account together? So anyway, like, things work out really well. Fast forward, we learned how to invest in real estate. We grow together as a couple, and now we have a small portfolio of 10 properties.
Good. Well, small still, that 10 properties is still quite a lot for many people that are just getting started, for sure. So maybe share a little bit about some of your experience in the investing world, and what strategy did you choose when I went to real estate? Was it mostly buy and hold, or what were you focusing on mostly?
Yeah, so all my properties are buy and hold. To me, it doesn't make sense to buy and sell all the time, and we are busy. We have 2 young kids, and each of us has our own business to build up, and so we're super busy. We have no time to do those flips and off-market deals. We buy student rentals. We have a few student rentals, a few near Broad University. We have one near McMaster. Obviously, it's not really a good time to own any student rentals these days. We also have 3 legal 2-unit. So legal secondary suite, and then we have 1 single family home in Toronto. We also have our own commercial property that houses our business.
Wow, congratulations. That's fantastic. That's awesome. Cool. So a lot of people, and I would imagine a lot of that experience, and obviously your accounting background, really, there's lots of really great tips and stuff that you could probably share. And that's really for a lot of the people that are joining us today. There's a lot of people that are just getting started, people that have been investing for many, many, many years. They really want to hear kind of some of the best advice that you could provide in maybe managing your property financials. For those that are just getting started, they get excited, they buy their first property, and they're just like, okay, I know what my cash flow is. I know exactly what that is. But as soon as they've acquired it, it's just like, what? I got to do books. What is this all about? I don't really know what the next steps are. So maybe just to kind of begin with, what would you recommend, or what are some of those things that you would suggest in regards to how best to manage property financials for those that are just getting started and are looking to obviously acquire their property? And then what are some of those next steps in regards to what are some of the best ways people should be managing some of their financials in their properties?
So to start off, we always recommend our clients to own property and own their property, probably the first investment property in their personal name, so then they can get their feet wet and see if this is something that they want to do. Some people really hate it. Majority of the clients that I work with, they have big goals. They want to buy 5, 10, 20 properties, and they want to replace their job income with investment real estate. But for those who are starting out, I always tell them, hey, you don't need to think about structure. All you need to do is just buy it in your own personal name and then see how it goes before you move on to buy your next one. Now, what I would also recommend my newer investor client to do is to set up a dedicated bank account just for the purpose of running your rental property. All the income and expenses would be coming out and going into that particular bank account, dedicated bank account. If you use your home equity line of credit to as a down payment. The money can funnel through that bank account and go to your house. This will help you to track all the income and expenses and all the money flow. At the end of the year, even if you don't have everything in front of you, you can just go back to your bank transactions and go through every single one of them. And chances are, if you only have one property, there are like maybe 5 transactions that go through the bank account. It would be super easy to sum up all the rent and how much you have put in, and all the utility costs, all the property tax, and so it just makes life a lot easier when you're small. A lot of people ask me if they would need QuickBooks Online or any software at the beginning. To me, I like it simple, simplify, whatever you're comfortable with, especially if your portfolio is just 1 or 2 properties. I wouldn't worry about setting up QuickBooks Online. I wouldn't worry about doing all these fancy stuff. I would just keep it simple. Excel spreadsheet, or even a piece of paper would work. You can just go through your income and expenses. It's easily tally up if you follow the system.
Yeah, and there's lots of great templates out there for people that are just getting started and are not aware of this. And it's just a simple profit and loss statement. That's all. Really, there's not really a lot of complexity to it. And to what Sherry just referenced, it's just like it's your rental income minus your property taxes, maybe insurance, interest on your mortgage, just a few key elements. And when you got 1, 2 properties, it's not a significant amount of work. But when you start to scale, things tend to change. And maybe that's, as we get into it, when would you recommend maybe starting to bring a bookkeeper into this, Sherry? Like, I know for me, when I first got started, I was at property number, I think it was 7, and I was doing all my own books. And I had my first 7 properties all on my own. And exactly what Jerry's just referencing is, I didn't have one account. I had one account for all of them. So it was a bloody mess. And then I learned a long time ago. So hopefully you guys are all listening, is having one account for each and every single property. And by doing this, it just simplifies your life. So for me, when it came to 7 properties and I was getting really way behind in regards to getting all this paperwork done, I accidentally skip a month and it just becomes a nightmare. And so for me, as soon as I hired a bookkeeper, it was just like the aha moment. I'm like, oh my God, this is great. So what would you suggest in regards to hiring a bookkeeper? Would you recommend what type of property, or when should you maybe consider bringing in a property manager or a property manager, a bookkeeper, sorry.
If you ask my husband, we should have hired the property manager like 10 years ago. I mean, the reality is it really goes back to your comfort level as well as your lifestyle. Some people love to do it themselves because they have the time, they can afford the time, and they want to get into the nitty-gritty. Some people are really comfortable using Excel workbook, and they want to do it and get their hands wet. But the reality is, for majority of the people who have no accounting background, are not familiar with what bookkeepings are, I think by the time you get to 3 or 4, you would want to get some help. Whether or not you get help from a bookkeeper or hire your accountant to do it for you, I think your time would be best spent on something that would produce you more, not necessarily income, but you can enjoy to do things that would make you happy. A lot of people are sweating and dragging, and sometimes we get clients that drag on forever to the point that it's late for a couple of years. So it's just not worth it.
Yeah, I agree. And I think that's the key piece, is once you start to kind of drag on all this stuff, it just, and again, to your point, now you're paying penalties and everything else that goes along with it with the government. So you just got to be you want to try to stay on top of this. And it was kind of back to my comment when I first was referencing this, and this one resonated well for me, is when I first started, I knew what my cash flow was when I purchased the property. But then over the years that I was acquiring it, I still remembered what my cash flow was, but I didn't necessarily know exactly what my cash flow currently is. And there's all these small little expenses that go up, like property insurance and things. And when you have that clarity behind it, and if you've got a bookkeeper kind of bringing it in, or if you're doing it, those are the numbers you should be kind of tracking and paying close attention to, and looking for ways to obviously increase the income, but also monitoring some of the expenses that tend to kind of come along with that. So maybe this is a second piece to that question, Cherry, what would you suggest are some of the most important factors people should be looking at when they are analyzing or considering looking at their financials in their property? Is there anything specific that they should be constantly monitoring when they're looking at this?
I think there's only so many variables in terms of property financials, right? You only have mortgage, and then property tax, insurance, and also your utility bills. If your tenants pay for utility, you don't even need to worry about it. In certain circumstances, a lot of my duplexes, they don't include utilities, but the utilities accounts are still with us, so we have to do a reconciliation. So you have to pay attention to those. My student rentals, we have an agreement in the lease agreement, a clause in the lease agreement saying that, hey, maximum utilities we would include is $300. And then so you really do have to then look into your utilities number. Now, in terms of your cash flow, I think I agree with you. Cash flow is the biggest number after you deduct everything, but there's only so much you can do. Pretty much you can only choose to change to a different insurance company.
Yeah, that's true.
And that's realistically, there's only so much you can do. One last thing that I do want to mention is probably not how you analyze your financials. What we found in our group, like my team, is that recently there is a credit union, local credit union I think in London, Ontario. They're willing to lend up to 10 properties in your personal name, and they're offering the mortgage at 2.85% or something.
Wow.
But they treat it as a business. So they strictly look at the cash flow of the property. So cash flow matters. So you may want to buy, I guess, I don't know about your audience, but in Toronto, even my father-in-law buys a lot of Toronto condos. And as you know, Toronto condos right now, the rent is not going up. You will be lucky if you have someone in. Yeah. So the numbers don't work, and to qualify under those type of scenario, it's purely speculative, hoping that I guess it's not purely speculative, but if you are only banging on the fact that the property is going to appreciate, it's probably not as easy for you to get financing in the future.
Yeah.
With other properties, right? So this credit union, they would want the accountant to do a financial statement. So not just your T776, which is the statement of real estate activities. It's not just that statement. They actually want a financial statement done, and they're evaluating it as if it is a real business.
Yeah, that makes total sense. And then at the same time, I would imagine when you're looking at your properties, they're obviously wanting to see the cash flow, positive, not necessarily negative, because that's obviously going to hamper the amount of properties that this credit union, I would assume, would also qualify them for as well. Like they'll say, well, listen, you've got 9 properties, they're all cash flowing. Yeah, we can give you the 10th one. But if they're not cash flowing, then there may be some limitations to that. But I would imagine you're probably going to get a bunch of emails and find out who's that credit union you're talking about, Sherry, because I want to know who they are, because that's really interesting to hear that, because normally most banks are like 4 or 5 and they've got you kind of capped out. So, but that's really interesting. So cool. Thanks for sharing that. That's awesome. Cool. Yeah. So guys, as you guys are joining us, please make sure if you've got questions, here's some of the questions. What's the name of that credit union? So here they come already. So as you're joining us, ask questions, guys. This is really all about yourself, all about you guys. If you guys got questions, this is your opportunity to ask. So share them, and I'll make sure that I relay that back to Cherry. So one of the questions I wanted to ask you as well, and it kind of goes back to what we talked about earlier, and you referenced owning a property, your first property in your own personal name. I get this question every single week, probably 3 times a week for many, many years. And I've talked to lawyers and I've talked to accountants, and I provide the same type of simple answer, which is talk to your accountant, talk to your lawyer. They'll give you the best advice. So without putting you on the spot too much, what advice would you give to people? So we've got individuals that are getting started, brand spanking new. And so there's a lot of confusion that's there. And like, should I be setting up a corporation before I start investing? And then the second part to that is, if they've started buying properties on their own under their personal name, when would be the right time to maybe set up a corporation to run their business? And I guess part of it is they're probably wanting to scale further, and that's probably part of the answer that you'll give. So I'll leave that with you. I keep talking about it, and I'll let you get the answer. So.
Okay, so I hope I don't make the mistake of making the wrong comment. I think setting up a corporation is not just a tax consideration. So you're 100% right. You should talk to the team of professionals. It's not just accountant. To me, I usually look at 7 factors in terms of whether you should set up a corporation or not. The number one thing is that, hey, like what type of strategies are you doing? Are you investing? Some of the strategies that people are investing in, the sale of the properties would be considered 100% income. Hey, thanks, guys. They want to join in. I don't know if they understand what flips are, but my son apparently understands naked put. So anyway, it goes back to the type of strategies that they are investing in. If they flip property, they do pre-construction assignment without moving in. These type of strategies, or even land development. I recently had a consultation that's building tiny homes in Windsor.
Oh wow.
So they bought pieces of land and built multiple tiny homes there and convert them into long-term rental. If you sell it, then the strategy would be different and the tax impact would be different. If you're doing a lot of these type of development deals or flips, they are considered active business income. The sale of these properties are considered active business income. And what it means is that, and also the profit from the sale of these properties, they are 100% taxable. So for someone who already owns, like let's say who already has a full-time job making 6-figure salaries, 100,000, any additional income, we're talking about 43% and up. So our marginal tax rate could go all the way up to 53.5% in Ontario. So 43 to 53.5%. If you make $100,000 from a flip, 50% first would go to CLA. So you want to avoid that. By having these properties inside the corporation, doing the business inside the corporation, you are only being taxed at the small business tax rate, and which it would be at 12.2%. 12.2% is way better than having them all in taxed at 50% for sure. Now, so that's number one thing. Now, if you do long-term buy and hold, there is no significant tax differences between owning them in your personal name versus owning them in the corporation's name from a pure tax perspective. Now, but then I also ask my client, do you own a small business? So I personally, I own my own accounting firm. My husband owns a different business. We co-own a third business together. So we all, like all these businesses, they are all considered active business. And which means that my income inside the corporation, they're only subject to 12.2% tax. So for $100,000 that I am keeping in the corporation, after deducting all my expenses, for that $100,000 profit, I pay 12.2%. That means I have about $87,000 left for me to invest. If I invest in my corporation, I don't have to take that $87,000 out to my personal name and pay another layer of personal income tax. I have the full $87,000 to invest. So that creates a bigger pool for me to invest. And therefore, for people who have small businesses inside the corporation, they have extra earnings saved in the corporation, and they should use the corporation to invest because it's a lot more tax efficient. Yeah, you have a bigger pool to invest. And then the other thing is, how likely are you going to leave your asset to your next generation? Typically, if you plan to leave all your assets to the next generation, we accountant would tell you to use you can use something called an estate planning, and typically that estate planning would allow you to lower the taxes that you need to pay, or limit the amount of taxes that you need to pay to limit the amount of taxes that you need to pay when you transfer the assets to your kids. Now, typically, estate planning involve a corporation. And if you don't have the corporation set up at the very beginning, when you transfer the assets from your personal name to the corporation, you would trigger land transfer tax, at least in Ontario. I know in Alberta, there is no land transfer tax. Depending on the location that you are in, it may not be beneficial for you, right? It could be a huge number at the end, and you either have to suck up the tax, paying the land transfer tax, or you have to pay the death tax. Because for anyone that died, they would have to dispose their asset at fair market value, at least in the CRA's eyes. So they would have to report the capital gain on fair market value of the property.
Very good.
And so,
Very good.
yeah, those are the three reasons. And then, of course, there's the legal reason. Do you want legal protection? Sometimes the insurance company, I know people talk about how we have we have insurance. Why do we really need the second corporation to get to protect you? Well, I've also owned. I've never really owned a commercial plaza, but I managed commercial plazas before. One of the plazas that I once managed in Waterloo, right next to the University of Waterloo. It's a gigantic plaza. And they had one winter, I got a call saying that someone was someone slipped and fall. And I thought this would normally be happening on TV. It's not a real situation, but people do call. And we thankfully had an insured snow removal company out there doing all the cleaning, and he checked up his schedule. There is nothing that day or the previous few days. That person is probably just calling to get some money off us. And you really don't know what you don't know out there. And as much as the insurance is out there, you're paying it for the peace of mind. The insurance first job when you have any claim is, did you comply with all these fine print on my contract? If not, my first job is to get out of the insurance claim.
Yep.
Yeah, so those are the primary reasons as to determining whether you should set up a corporation or not. Of course, the other reason is like, how many properties are you planning to buy? If you tell me that, hey, Chair, I think I'm happy with just a couple, and then I'm going to be done, I don't think you should set up a corporation. But if you're thinking, hey, like, Cherry, I think I'm going to replace my income and I need 20 properties to replace my income, 100% I would set up a corporation, because that's going to protect you a lot. Everything that you own in the corporation is at least sheltered in the corporation. And corporation setup also allow you to have more flexibility in terms of qualifying for mortgages.
Yeah, agreed. Yeah, I agreed. And now here's the second part to that same question. So for a lot of people here that this may be a relatively new business for them too, and they don't have the capital, but they're looking at bringing in joint venture partners to do this. So their business is, they own 0 properties, but they're looking to do joint venture partnerships with people. Would you recommend a corporation if this is their first deal or not?
Now, joint venture is a form of ownership, right? It still goes toward what the underlying investment strategy is. Yes. If it is just a simple long-term buy and hold, I probably would not do the setup of the corporation unless you have a solid plan. Hey, this is the way that I'm going to grow, and I'm going to grow to like at least 5 to 10 properties, then I would set it up. Otherwise, at the beginning, again, I would just do the very first one in the personal name to make it easy for you and easy for your partner. If the underlying investment strategy is a flip, then it could be a different story, because then the income is taxed at a lot higher rate. And also where the money is coming in from. Sometimes your joint venture partner could be the busy business owner, and their money is really coming from their business. I have a client who has a joint venture partner. The money is funded through the business, and you pretty much don't have a choice under those circumstances, right?
Yeah, good. And so for all of you that are listening, and when you are hearing from people that are talking about, should we set up a corporation or not? And when Mike Ponte or somebody else says, talk to your lawyer or accountant just to get the best advice, I hope you're listening to what Sherry's saying, because there's a lot of different variables that need to be considered. So make sure that if you are going down that road, to just make sure that you're asking the appropriate questions, and you'll get the best advice by talking to the professionals that are part of your investment team for sure. So I hope you just listen to that, because that is really where the answers really truly need to be coming from. So it really depends on where you're going to go. So I got a couple questions from people that are asking. So I have an individual here that's opened up a corporation, but all properties are still under their personal name. Can certain real estate expenses still be deducted from the corporation?
So, no. I think I understand it, but then that means the company doesn't have any income. What's the point of claiming these expenses in the corporation if the company has no income? You would be better off claiming it in your personal name, because all the rental income is, you can deduct that same expense and save you some taxes in your personal name.
Yep. Okay. Good. That's a great answer. I got another really good question, actually. Grant and Karine, thanks for asking this one. I think they're actually clients of yours, so I'm not sure if that's true or not. But so the question that I've got here, is it better to have one corporation to acquire properties and the other active and then have other active real estate investments and property management on other companies? Also, should I put a trust to wrap up the corporations together? So they've got one company for acquisitions, the other one for property management. And is it a good idea to create a trust to wrap all the corporations together?
Okay, so many different questions. It's great questions. They're all great questions.
Really good questions. Yeah.
Yeah. So let's just go back a little bit. So typically I start off with having one corporation. If you are my client, I would advise you just start off with one corporation. Should you set up, typically people talk about setting up a second corporation as the property management company. Just to give everyone a little bit of background, earning straight rental income specifically is defined in the income tax act as part of the specified investment business income. Specified investment business income are taxed at 50% in the corporation, 50. Now, out of the 50%, 30% would be refundable if you declare a taxable dividend to the shareholder.
Right.
What it means is realistically, you have to pay something to the shareholder, which is you, because you are the only shareholder of the corporation, or you and your spouse. And you then personally would have to report the income that you receive from the corporation so that the corporation can pay less tax and you absorb some of the tax in your personal name. Now, that's the whole scheme. It gets complicated. Now, so some genius accountant out there, not me, long time ago, invented this thing. Notice that there is a function in the real estate investment world that, like there is that property management function that is not active, that's not passive, that's not part of collecting rent. It's actually quite active. So by establishing a second corporation, they want to operate a property management company and carve out that property management function from a real estate holding rental investment holding company so then they can just pay the active business rate, which is only 12.2% in Ontario. So that's the whole scheme. You have to set up a second corporation, essentially charge the real estate holding company property management fee, whatever the property management fee is out there in the market. That's the idea, because they are both owned by you, or right. Even if it's owned by your trust, they're still having the same shareholder. They're related to each other. So the transaction that happened in between the two companies have to be at fair market value. So the property management company would have to charge the real estate holding company property management fee, and typically is at market rate, and the market rate is like 8% or 10%, at least here locally here in Ontario. So if you charge that fee, the 10% property management fee can then go over to the property management company, and you only pay 12.2%. And on the real estate holding company that you pay 50% income tax rate on, you can then get to deduct that property management fee as an expense, so you have much less income, or close to nothing, no income at all. Now, this is a very common strategy promoted by many different accountants before me. I always caution my clients in terms of executing this type of strategy. I believe in tax planning. I do. I believe in saving taxes, but the majority of the clients that set up the active business corporation, the property management company specifically, they set it up for the purpose of saving taxes, because that's what they were told. But then the problem is that to execute this thing and operate this business as if it is a real business, there are many different steps behind to execute it properly so that it can stand in court if you ever get questioned by CLA. This includes signing the property management agreement. This includes issuing the invoice. This includes actually doing work on behalf of the property management company, documenting the work that you did. This also includes money changing hands. So many people would leave it to the accountant at year end to do a few adjustments in the books, but money has never changed hands. If you ever put this case in court, it will not stand because there's no substance to any of the transaction. It's just paper transaction. So the question I ask my client is that, hey, do you have the time and patience to do all these? If you don't, then maybe you should not touch it at all.
Yeah.
Because the setup, there's the setup cost, and then there's annual filing cost of a second corporation, and then you have to maintain it as well. Now, then there is also a third factor, a different factor. Majority of my clients invest in residential real estate. So when you invest in residential real estate, you rent it to people that use your home, use your rental unit as a home, and that you don't charge HST on. And when you operate a property management company and your portfolio is big enough, meaning that you would collect more than $300,000 of rent, in my example, then you would charge $30,000 of property management fee. If you charge more than $30,000, you're supposed to charge also HST. The reason is because there is a small supplier rule that allows you to not charge HST. So you have to, once you get over that $30,000, then you have to charge HST. Once you charge HST, you lose 13% tax saving. Because on the real estate holding side, you can't recoup it. Now, of course, it's different when you own commercial properties, completely different. But if you own residential properties, you have to pay attention to that 13% extra cost. And that makes the whole management company very unattractive.
Yeah, very good advice. Grant, Karina, hopefully that answered your question. And that's obviously there's a lot to it, obviously, too. So lots of great information. And again, back to talking to your accountant, they're going to provide you the best advice that they can in regards to what your envision or what your vision is in your business and how you believe you want to be managing effectively, and obviously for tax savings as well. So listen, guys, you guys are hammering me with fantastic questions, but I think we're going to be here for about 4 hours. So I'm going to do my very, very best to try to get as many of these questions as I can answered. But just rest assured, if we don't get them answered, we will get some answers to you at a later time. Cherry's also part of Savvy Investor as well, so hopefully she can jump in and just chime on a few of the comments as well that they come. So one of the questions that I have, and this is a good one, I think, again, going back to corporation side, should we form a corporation federally or provincial level? And what are the pros and cons behind that?
It's a great question. It doesn't matter whether you form a corporation in federally or in a specific province. If you form, let's say, an Ontario company and you need to buy real estate in BC, what you would do is basically you would cross-register in the BC with the BC government and get a BC government tax filing number. If you have that federally incorporated company, you do the same thing. You may be based in Ontario, you would already get that Ontario number. But if you were to buy any properties in the BC, then you will have to get that BC number as well. Now, there are provinces that are a little bit behind in terms of setting up your corporation. A lot of paper documents are still required. So in those provinces, it makes life a lot harder to set up a corporation locally there. For example, New Brunswick is one of them. You actually need to buy the seal and everything. In Ontario, it's just paper, everything electronic. So that also goes into the consideration, because then you may actually need to fly over to sign paper and whatnot. But typically, there's no significant difference. You do need to track income from different provinces, but that would be it.
Okay, good. Hopefully that answers your question there, guys. Again, Grant, Karine, thank you for that. Very good questions. Judy, I'm going to try to answer your question here. So, Cherry, does one need to employ 5 full-time employees for a business to be considered active? I think that one's not too challenging, but do we need to hire five employees for the business to be active?
No, so basically the law says that your business, they automatically assume your business is active unless it is specified investment business income. Now, what qualify as specified investment business income? That includes real estate rental income, the interest income, dividend income, royalty income. So these are all we commonly know as passive income. So basically, it's everything active except what I just listed.
Yeah.
Now, in order for what I listed, the specified investment income to qualify to go back to become an active business income, you do have to hire more than 5 full-time employees. So if you operate a real estate rental portfolio and you have 20 properties in there and you feel that you need that 5 full-time employees, by hiring that more than 5 full-time employees, then you would be able to report your rental income as active business income rather than passive.
Cool. Awesome. Very good. Thank you. Hopefully that answered your question. I think it was Judy. Yeah, Judy. So hopefully that answers your question. So I've had a couple questions on this one, and then we'll start continuing on here. Sure. So Sherry Harbor, I set up a 3-tier strategy. My question is about active and passive income. Do you hold properties in your accounting business? Question number 1. And I'm hoping to hold and process active flips in a corporation that we already have that is not real estate related. It is related to construction. Is that fine? Did you get that? So it's 2 parts. Okay.
Yeah, great question. I actually answered one of these questions, similar questions, on my website. I'm going to self-promote myself. You can. That's
okay. You go.
Get my weekly tax tips. And some of you commonly ask questions on my website, and my website is realestatetextips.ca. And if you go there and subscribe, you would be receiving my weekly tax update. Now, one of these, I already answered the question. If I don't answer it, I guess answer to the extent that or if you need to have a refresher after, by all means go to my website. You scroll down. It's just a couple of blog posts ago that I wrote about this exact topic. So typically, I do not advise my clients to own real estate, at least not the long-term buy and hold. Mix it with the active business. Now, the reason why I would do that, you're totally allowed to do that. So from legal perspective, from accounting perspective, you're totally allowed to do that. And for the accountant to file your tax returns accordingly, so they would basically do the portion of the rental income into the passive side, and then your construction business would still be reported as active business income. Now, it's totally allowed. The reason why I would not do it is because, like, for one, do you really want to mix your construction business income or business risk with owning a long-term rental property? I don't know the type of construction that you're doing. It could be something that could easily get sued. I have a client who's a foreman in construction site. He builds lots and lots of homes. And if anything happens at the site, he could easily be sued by one of these workers. And so he doesn't even want anything to be in his name. So do you really want to bear the risk of mixing the risk of operating a construction company together with owning your long-term rental, your retirement plan? Because that long-term rental typically for a lot of people is their ticket to retirement. So I don't necessarily agree to put them together. Now, that's reason number 1. Now, reason number 2 is that I personally, because I'm an investor, I had this weird experience earlier this year when I tried to refinance a property inside my corporation. And this corporation primarily is a holding company. It's the very first corporation that we set up. It has all our initial properties, all our properties are in there, all residential properties. And initially, we also had some commission income from some other sources, and I wanted to put it in the corporation, but it's not big enough to justify setting up a second corporation at the time, and therefore we had all these weird income, a couple $1,000s here and there going into that corporation. And it turns out the banks don't like that. It turns out the bank only like to work with something called holding company. Now, what it means is that holding company in the eyes of Bank of Canada or all these A-lender banks, all they want to see is the company that owns real estate and that's it, and does investment and that's it. It cannot earn any active business income. So I was getting the first underwriter approved because he did not see the $2,000 commission active income that I received. You would have thought that $2,000 would actually help qualify. And then
Right.
the second, because the first underwriter went on vacation, second underwriter took over and saw that 2,000 and immediately, nope, we're not funding this deal.
Wow.
So,
Amazing.
so that is just my experience talk. You may want to check with your bank. I checked with a couple of banks and the brokers are saying the same thing. You may want to check with your own banks, and those are the reasons why I would not put it in an active business company.
Okay, perfect. Hopefully that answers your question there, Sherry. Again, lots of great questions. We're probably not going to get to all of this. So I hope you guys are all enjoying this. I know, Sherry's just giving bombs to everybody here in regards to information. And give us a thumbs up. Make sure you give us a thumbs up just to make sure that you guys, number one, are really getting this and absorbing this, because this is actually fantastic information. So I got another question for you on specifically about renovations, actually.
Sure.
And specifically buy and hold. And, how is CRA looking at renovations in a buy and hold structure? So I know for myself, I remember having a CRA review on my portfolio one time, and we picked up one particular property, and it went fine. Everything went well. We started talking about capital improvements into the project itself. And we had actually put it into the P&L versus maybe as capital improvements, and they didn't really necessarily like that. So could you maybe share a little bit about capital improvements in the property itself and how it should be referenced in the property financials? So for those of you that are new and learning this is, again, a lot of us will be doing renovations. It's really, really important how we code this, or we reference this in the financials. So Sherry, if you don't mind.
Wow, you're asking a lot of, I'm checking my list of questions. It's not really here. You're really testing and pushing my technology.
I'm challenging you. So
yeah. So great questions. There are lots and lots of. It's such a great area. There are multiple court cases that goes with this particular area. The reason is because the way CRA look at it is that when you do capital improvement, if you even use the term capital improvement, they would automatically want you not to deduct it. They would want it to be added to the cost of the building because it's improving the building. So it's improving the value, and therefore they want it to be added to the cost of the building. You still get the deduction, but you don't get the immediate write-off. Your deduction won't come until when you eventually sell the property. So you want your buyers as a taxpayer is to write off everything. You want to not call it capital improvement. You want to call an expense as repairs.
As a repair.
Okay. Yeah. You want to call something as repairs. Now, but there are specific situations that CRA would consider an expense as capital improvement. Now, using a simple example is that you actually improve the quality of certain section. Like if you replace carpet with hardwood, that is called improvement. If you replace the entire kitchen and make it an open concept kitchen after, because a lot of people in my world are doing basement rental and they get the whole thing, that is also called capital improvement. So if you do any improvement, they're generally considered as capital improvement. If you do any upgrade, they're generally considered as capital improvement. Now, there are two specific situations that CRA, even if you don't do capital improvement, even if you just paint the wall, changing the light bulb, they would still consider the expenses as capital improvement. The two specific scenario is when you first buy a house. When you're buying a house to get it ready for rent, it's very common in the real estate world. We buy an older home and we convert the basement to legal secondary suite. The whole expense, even for the wall painting, for changing the light bulbs, changing the toilet, replacing the faucet, even if they exist beforehand, because you incur the expenses during the time you immediately after you purchase the property, and the purpose of the expense is to incur for the purpose of getting the house ready for rent. That period of time, that expense considered capital improvement is specifically called out in the CRA's Now, the other scenario is when you're getting ready for sale. So typically you would, you would go into a house and then you would start painting, like if you're getting it ready, give it a fresh look to make it nicer, to attract higher bid. That expense that you incur to get it ready for sale, they also consider capital improvement, and therefore it's being added to the cost of the building rather than being written off as a repairs. Now, understanding the concept of capital gain and income is very important because repairs are expense that you write off against your income. So income is 100% taxable, repairs is therefore 100% deductible. Now, if you have capital improvement added to the cost of the building, if it is a long-term buy and hold, any expenses being added to the cost of the building, if you buy the house for $500, spend $100,000 on improvement, so your cost is $600. When you sell the property for $800,000, you minus the $600,000 cost, now you make a capital gain of $200,000. Out of the $200,000 that you make, $100,000 is taxable. So meaning that the expense or whatever you call as capital improvement, it's only 50% taxable. Deductible. So you always want to call it as a repairs. This is why there is a bias that we always want to be as aggressive as possible. But if you are asking for CRA for money back, especially on your personal side, if you deduct $20,000 repair, immediately flagging them, asking for an audit. That's what you do. So sometimes we look at your situation, and even though sometimes it's a repair, we still try to stay on the right side to avoid the cost of getting audited.
Yeah, and that was the common question that we heard too as well, actually from CRA. And again, we finished our review. We actually had a pretty great discussion after the fact, after the review. We showcased all of our numbers and our financials, everything went fine. And we just kind of had an open dialogue, an open discussion, which was kind of shocking when you're having a discussion with CRA and just learning about some of these things. And I'm like, oh, that's really, really interesting. Fortunately, we didn't have any major expense in that one particular year that we would have normally put in the P&L. But to your point, it could get flagged. And if you've got a $20,000 expense that is not standard, not normal, then those are where some of the cautions have got to be taken into account. So
absolutely.
Yeah. So let me ask maybe a little bit of a simpler question. And you guys are hitting some great questions. We're just not going to be able to get all of this. We'd be here for a couple of hours and Sherry's not going to have any voice left. So, but keep throwing them out there. We'll make sure that we get our answers to you guys the best we can. Again, I hope you guys are enjoying this. So I guess for new people that are getting started, Cherry, what would you recommend? What are some of your most common tax tips you would give maybe a real estate investor, number one? And then the second part to that is there any tax traps you want to maybe avoid? Any suggestions for those people that are just getting started? Any common tax tips you would give them as people are just getting started?
So we mentioned earlier that setting up an individual bank account for each property, having that dedicated credit card as well for business purpose, it would help your accountant as well as you yourself to keep track of the financials of your properties, because you can essentially just check your account balance and then you will know whether the property is making money or not. So that's number one thing. Number two is keep your record up to date. It's very important to do your work upfront. It helps you to get financing. It helps you to finish your taxes on time as well. One of the, I guess, a few things that that I suggest my clients or any newer real estate investors to consider is to keep track of all the receipts or keep all the receipts. Many clients come to me and, well, let's step back. If you're eligible to deduct expenses. This is the general deduction rule. You are eligible to deduct any expenses that you incur for the purpose of earning that particular income. So if I want to deduct my car because I drive to my rental property to check out the rental property, I want to deduct my car expense, then you just need to be able to establish the link to incurring the expense and earning the income. So a lot of the people that I work with don't understand that, hey, it's not just keeping the logbook. You also have to keep the gas receipts and then the insurance and then the maintenance records and all these other things. And you also need to keep the actual receipts and not just the visa statement. Visa statement would help the bookkeeper or accountant to finish the bookkeeping quickly. But in terms of audit, you still need to keep the actual receipt. Now, if you do want to claim automobile expenses, sometimes people don't consider that as that big of a deduction, and therefore they just ignore it. But if you do that, you do need to keep your auto logged as well. You are also eligible to claim home office expense, provided that your home is your primary place to operate your business in, and so there are some rules that you have to comply with. But again, to claim your home office expense, you still need to keep all your utilities bill, your property tax, your internet bill. All these have to be kept. I think those are the biggest things that I would mention.
Good advice. Good advice. And that's the one thing, you hear about these people just getting started. Well, I've got a business now. I've got my one condo that I purchased. So now all of these things that I own around my house, my vehicles, my 3 cars, all the kids' computer, they're all tax deductions now. That's great. And so just be really cognizant. Again, talk to your accountant, make sure you review this so you don't want to get flagged too, right? So awesome. So I'm going to kind of maybe ask one last question. And maybe a little bit of a doozy. And we talked about this earlier, then we'll kind of wrap it up for the evening. And guys, I hope you guys are enjoying this. Again, please ask the questions, keep posting accordingly. We'll do our best to get answers to the questions that you have. Secondly, the other option is if you are wanting to talk to Jerry as well, you can definitely reach out to her as well. Jerry, what's the best email or phone number? Where's the best place to reach you if they wanted to reach you? So
you can reach out to my office at 416-548 4228, or you can email us at admin, ADMIN, at cccpa.ca. So Cherry Chan Chartered Professional Accountant.ca, cccpa.ca.
Awesome.
Of course, there's tons and tons of information because I've started writing blog posts since 2014, and I'm still writing blog posts I try to do it on a weekly basis. I'm a little bit behind the last couple of months, but it has tons and tons of information on my website. You can just simply go to realestatetextips.ca, sign up and keep up to date, and also use the search function. There will be a bunch of resources available for you.
Yeah, awesome. Thank you. Okay, so my last question is for those Canadians that are looking at investing in the U.S. And I know we talked about this before we dialed in there. And there's a lot of kind of confusion that goes along with taxation, double taxation, and setting up a structure. So, and I know we talked about this before. That's not really your area of focus, but maybe you can kind of share a little bit of some of your knowledge about maybe Canadians when they're considering going down to the States. What are some of those things maybe Canadians should be considering if they're looking to go down that road?
That's great. So there are so many different, experts out there. You can even visit. I think there are some U.S. company that market to Canadian company, and they would have a lawyer on their team that says, I can set all these up for you. I think before you go out, I've met with people who set up the entire structure without buying anything. And just pay essentially the lawyer to set it up all for them. So first thing first, you have to understand this is something that you want, and just don't use a lawyer in the U.S. Side without understanding the tax implication on the Canadian side as well. The cross-border taxation is a special thing that people specialize in. There are multiple firms out there that would specialize in understanding the cross-border taxes. Now, the second thing is that U.S. tax is complicated. Canadian tax is also complicated. If you don't have the right structure in place, you may risk paying double taxation. So there are two common forms of ownership. If you try to buy real estate in the U.S., one is to own it personally. Now, everything is personally, and typically the agent or the lawyer do not advise you to do that because apparently the US people like to sue, and you might be exposed yourself to a lot of risk. But by owning them personally, you would then be able, 100% you would be able to get a credit in terms of what you pay in the US, and on your tax return, you don't have to pay that amount. Essentially, the way that the Income Tax Act would look at what you already pay in the US is that they would give you a credit back. So they would lower your tax by the amount that you pay to the US government. So there's no double taxation. That's the simplest form and cheapest form of owning real estate in the US. Now, the second very commonly used structure is having a Canadian holding company set up, which a lot of you would have. That can be done relatively inexpensively because you already have a holdco. And then there would be a U.S. corporation. And underneath the U.S. corporation, there is a U.S. LLC. It's called limited liability something. And then underneath the U.S. LLC is then owning the properties themselves. Now, as you can see, you need to set up the corporation and then the LLC to own the property. So there are two structures that you essentially have to file taxes on, and the cost of setting it up is expensive. So you really need to understand, hey, like, am I doing a few of these? If I do a few of these, it would make sense. If you do only one, maybe it's not really worth it. So you really need to understand the ongoing cost of filing, and if they are filing it correctly and in compliance with also the Canadian tax law, and you structure it in the way that you can avoid double taxation when you draw money out from your corporation, US side, those are the factors that goes into the decision of whether you should buy in the States. And make sure that you talk to the professional that work on both sides, because that really matters.
Absolutely. Absolutely. So for those of you considering it, there's a lot of great information that's coming up on the post. Grant Crean, thank you for sharing all this wonderful information that's being posted there. And I hope you guys have all enjoyed this. I know for me, I've learned a ton, and hopefully you guys have all found it the same way. People are really great feedback there, Sherry. I know you haven't seen this yet. But anyway, so we're going to kind of get things wrapped up. So again, first of all, I want to thank you guys all for joining us this evening. Cherry, thank you for joining us. It's been great, really great information. I know for a lot of people saw a lot of value here. So thank you for joining us tonight. So
thank you so much for having me. Really an honor. And thank you for thinking of me. Honestly, that's a lot of fun sharing the knowledge and being challenged by all these questions.
It keeps us on our toes, right? That's the important part, right?
100%, yes.
Or else life just gets mundane. We always got to challenge ourselves. So.
Always looking forward to these type of challenge.
Good. So as we're kind of wrapping things up here, folks, next week, next Wednesday, 5 p.m., we've actually got another great guest speaker, Calvin Hexter, going to be coming to join us. So for those of you that have been interested or wanting to learn more about purchasing foreclosure properties, how to find them, what to look for, and even more importantly, ensuring that they are a true opportunity, make sure you join us. So it's going to be next Wednesday, 5 p.m. Pacific Standard Time, right here on the Savvy Investor Facebook page live. There's going to be some great tips that are being shared there as well. So hopefully you can join us for that. So another great presenter. So without further ado, Cherry, thanks again so very much for joining us. I want to wish you guys all a wonderful evening, and thanks again for being part of this. Have a good evening.